Welcome to the Kimberlite webinar to take a comprehensive look at the artificial lift and production chemicals market. My name is David Batt, president of Kimberlite Research, and I'm glad you can join and watch this webinar with us today. I'm accompanied by Andrew Thornton with Kimberlite Research, and together we'll take you through our 45th Kimberlite webinar. These webinars are presented and hosted on behalf of the many oil and gas operators around the world who participate in our industry studies. In past webinars, we've addressed the competitive position and health of many oil field services, including drilling services, hydraulic fracturing, intervention, subsea wellheads. And today, we'll be addressing the artificial lift and production chemicals market with production solutions. For those of you that are participated in our past industry studies, we thank you for your participation. If you would like to have more customized presentations for your employer, we commonly host customized presentations for oil and gas operators around the world. Just reach out to us and let us know. Today, the findings that we'll be presenting to you are based on interviews with 441 production engineers and managers worldwide from 240 E&P operators. Some of the performance trends that we'll be sharing with you today are based on interviews with over 3,600 production engineers and managers and about 140,000 supplier performance ratings. As many of you probably know, at Kimberlite, each year we conduct about 3,000 one-on-one interviews with users from oil field services globally. About half of our research is international, half North America. Our industry reports span the swath of the oil field, ranging from formation evaluation, drilling, subsea completion, and production. Today, artificial lift and production chemicals. Well, we will be using this quadrant map or value map quite a bit today in our analysis and analytics. So I'll explain this really briefly before we dive in. We cross-plot oil field service company supplier performance on the horizontal x-axis versus pricing strategies or pricing competitiveness on the vertical y-axis. Based on customer reviews from oil and gas operators around the world, any oil field service provider that plots in the top right is positioned as a premium offering, costs more but worth it. Bottom left, a discount provider, get what you pay for, but delivering good value. Bottom right, value advantaged. And top left, competitively disadvantaged. Any oil field service provider that plots in the top left-hand quadrant based on customer reviews with oil and gas operators really exhibits an opportunity to either improve performance and move to the right to defend current pricing strategies, or perhaps realign their pricing strategies to get back in alignment with their performance profile. So I think with that, we'll go ahead and kick off. Andrew, to get us started, what can you tell us about the market macro, and in particular, what are you seeing in the world of production services and production solutions?
All right, thanks, David. So it's a very interesting time in the market, obviously, as we move into Q4 budgets and planning season. But let's first of all kind of look at, so when we spoke to oil field operators, what they're expecting their expenditures in artificial lift to do over the next 12 months, you can still see, despite some kind of a lot of hesitancy in the market, the majority of the people we spoke to still see expenditures to either increase or stay the same across operating basins. Now, we can see international land and offshore a little bit stronger than North America, but even in North America land, we're still seeing the majority of the individuals anticipate things to stay the same or actually increase just a little bit. Now, what this is doing is this is creating this diffusion index, and that's probably best explained on the next slide.
Right.
Anything above 50 essentially represents economic expansion. Anything below 50 represents contraction. So what we can see here is that we're still at pretty strong growth at 69 as a worldwide indicator. We can see North America here rolling over just a little bit, but still not that it's stopped altogether. And so we're still in a healthy growth market overall for artificial lift and expenditures in the production space. Now, conversely, we can actually now start to see this trend against different components of the oil field, so drilling and completions. We can see now that expenditures in the production space, artificial lift and chemicals as an index, looks set to outpace drilling and completions again for the, this is now getting into the third year of outpacing those two other aspects of the oil field.
Right.
When we had the large market contractions, you can see drilling and completions quicker to go down, but also faster to rebound. Artificial lift and chemicals a little bit steadier, but as operators focus more on production optimization and production efficiency, we anticipate this trend as a relative basis to continue overall. Now, what we can also start to see here is this variance overall in terms of pricing. I get asked about pricing all the time. What's happening in pricing? So what's the expectations from the operators? As you can see, similar question. Do you anticipate it to increase, decrease, stay the same? And what we're seeing both in the artificial lift and production is low single digits in the North America land expectations to kind of mid to slightly high single digits international land and offshore in terms of pricing expectations. So operators are anticipating at least a slight increase in pricing to go with the increased overall demand.
Okay.
Now, switching from artificial lift into just the broader market environment, what's going on in drilling? We expect wells drilled to be down 12, probably now realistically around closer to 14%,
even 15%.
Even 15% by the end of the year. We're still moving through the year. Into next year, we expect wells drilled to be down 2%. Rig count's going to be down in the US, let's say 10 to 11%. So slight efficiency gains there. Canada's been relatively steady in terms of its activity at single-digit growth. It's got slightly different economics, obviously, to the lower 48.
Right.
Now, one of the big things we always like to point out is, well, why are we entering this kind of downward trajectory and steady state or slight bearishness? Well, one of the reasons is supply. We have so much supply in the marketplace, and the US is a huge contributor to that. So we look at production here as the red line. That continues to increase. We're going all the way back to the 1980s when you came out into the industry, David. And I like to point out that I wasn't quite born at a certain point there, but that's okay.
That's okay.
But, as we look at the rig count, that has steadily decreased. And yet production is it's not quite at records as of next month, but it's pretty darn close.
Right.
Efficiencies. We're seeing continued efficiencies and productivity, and that's driving this increased production. We don't necessarily need the 2,000 rigs we had previously. As a result, we anticipate the rig count for next year pretty flattish, slightly down from here on out. Potentially you see an uptick in the gas rigs in the second quarter, but given what we heard from Saudi Arabia last week and the fact we have a lot of macro trends in the marketplace right now,
right,
there's some movement either direction of this, but I would imagine this is broadly the mean at around 550 rigs in the lower 48.
Okay.
Now, internationally, we still see reasonably strong growth. Next year, we're looking at around 6 to 7, 8, 9%. And on the offshore environment, and we'll discuss this a little bit, a lot of that comes down to pricing, though, as the demand for best quality equipment continues to increase. These efficiencies don't happen through commoditized products. They happen through technology, through innovation, through best-in-class service. And so as that demand is increasing, so we're seeing pricing driving a lot of this versus, say, activity.
Very well.
And now, as we turn into, another key aspect that's kind of developing over time, and also driving some of that demand is automation, artificial lift, production optimization, I should say. When we spoke to the oil field operators, we could see one of the biggest improvements people are looking for in artificial lift was automation through AI predictive analytics and how that's driving a lot of expenditure change, as we talked about earlier, production optimization. In terms of who's actually best positioned to supply these today, there's a range of suppliers, each trying to really get their foothold. But obviously, ChampionX of Xbox, Weatherford has got a strong footprint, particularly in the rod lift component of the world.
See, it's very fragmented.
But it's extremely fragmented.
Looks like there's a lot of innovative companies trying to come up with new algorithms and better mousetraps.
New algorithms, better mousetrap, and the mousetrap that works for their particular technology. You've got some ESP suppliers like a Baker Hughes. They're focusing on the ESP side of things versus ChampionX, Weatherford. They've got different technologies, and SLB's kind of got a whole swath of different artificial lift components that it can dig into. When we actually look at other aspects, we link artificial lift to completions, and we look at the use of downhole pressure and temperature gauges and how that's setting to increase over time as well. Use of chemical injection pumps and how we're going to start to look to automation within that space as well drives in it. And this is an interesting graphic when we talk about, the mean time between failure and the difference when you have an automated chemical injection program versus when you don't. It's a significant improvement. So we're seeing all of these different components drive that digital and automation space, which ultimately I think is also driving part of the expenditure and the pricing increases as well.
I'm going to pick up here a little bit because this kind of caught my eye, if you don't mind. Most wells are using chemical injection pumps, but to this day, I'm a bit dismayed at how the range and mean time between failure ranges from, 1 in 4, 26% of the operators indicating that their chemical pump's going to fail within 6 months or less, right? Some get up to a year, some get better than a year. But more importantly, the accuracy of the dosage rate varies from plus or minus 5% to plus or minus 20%. Most of these wells, when they're put on this chemical pump, it's like a patient going into ICU and being put on an IV. You want to make sure you're injecting at the proper dosage and that you're reliably injecting. It's very clear to me that there's room for improvement here. The operators are clearly investing digitally here and for good reason. But if you can get that chemical pump to last more than 24 months as an operator, your mean time between failure runs are going to improve by 20 to 30, 40%, depending upon if you're ESP or gas lift. Rod lift is only 4%, but last year it was a little bit higher than that. And so it's really interesting that this is another fragmented space with 30-something different suppliers. Obviously, TexAm and ChampionX and TechStream are some of the leaders there. And they're also recognized among their customer base for offering reliable pumps and accurate pumps. But I can see this entire digital investment cycle continuing at a very fast pace. But maybe changing off of digital, Andrew, can you maybe take us through when an oil and gas operator drills a U.S. land well, what forms of lift are they going through and how many different forms of lift and what does that whole landscape look like?
Yeah. So depending on who you talk to, everyone's got a different view of artificial lift and what that looks like. But we kind of break it down into these components and we look at the various different basins around the world, the types of technologies used. So in the US, when we look at the install base, rod lift is still the predominant form of lift from an install, but that's life of well. You've got strong proponents in gas lift and ESP. International land's a little bit different, a much higher use of ESP as a proportion of the total install base. But to your point, David, it's about a well's life cycle and what's being used and when. So when we break that down and we say, okay, well, this is the US land market. If you're using one form of lift in the US, 50% of the time you're going to put that thing straight on rod, but that's not a high usage. You can see it's about 19% of the people we spoke to. The large proponents sit here within that kind of 65% using two systems. So what are they doing? They're starting off with ESP or gas lift for the most part, and then they're switching it on to rod lift as well. And so we're seeing that, I need to have a well life cycle program, but not all basins are created equal. ESP, yes, it is the predominant use in US land, but let's switch to, let's say, everyone wants to look at the Permian, and ESP is certainly a key component there. So you see this pattern, but let's switch to, say, the Eagle Ford. Now you notice here that the Eagle Ford is very gas lift tends to be preferred method first and foremost. Well, partly that's a lot due to what are we drilling in the Eagle Ford? Yes, you've got oil, but you've got dry gas, wet gas. Where you've got greater GOR, gas lift as a technology tends to be somewhat preferred and can be very economical and very viable.
We've noticed too, also in the Delaware Basin, or the Permian Basin, a much higher GOR, it's very much gas lift favored over ESP. But in the Midland Basin of the Permian Basin, they really prefer ESPs over gas lift. So this battle between ESP and gas lift, I think part of this battle is being determined by the GOR of the well, and the operators are beginning to figure that out.
I think it's the GOR of the well. I think it's the efficiency that you're getting as well. The economics obviously play. Another thing we should talk about ESP, and it's not in this slide deck, but it's something you and I have talked a lot about, is what do ESPs need? Power, right? And powering the oil field is probably going to continue to be a huge theme that we see, and a huge challenge across operations. And if you've got an opportunity to put something on gas lift, if you've got a lot of excess gas, which some areas do, why not do so?
We're low on gas. Any thoughts as to the growth of ESPs and rod lift markets, and what the kind of the installation history looks like here moving forward?
So we can certainly look at the install base, and we've got this graphic here, but this is a good opportunity for us to maybe look at our new planning module and kind of what that's telling us about these various markets around the world.
Right.
So this is the ESP market as we see it today. It's a little under $6 billion on a global basis, and next year we see it growing to 5.8 billion to a little under 6, so about 3% growth.
Yeah.
Now, what's interesting for us is that we see that growth mainly coming in the international land arena, about 4% growth, and offshore. There's a higher increasing adoption rate of ESPs offshore. It's more critical wells, and there's a higher technology barrier there, but certainly that's a key growth area, versus the US or North America at around 2% growth.
So even though in the US we're projecting to drill, say, 2% fewer wells, the ESP market's projected to grow up 2%. So this is a strength area for the market.
Exactly. And when we kind of look at what's driving that as well, we also look at, we talked about it earlier, pricing. What's going on in the pricing component. So yes, it's 2% growth, but a big component of that is sitting within the price bucket. Now, if we switch to a different product line here, and we look at rod lift, and let's just focus in really on the North America market, and what we're seeing, again, it's around that 3% mark, 2 to 3%, slightly higher usage. Pricing for rod lift and activity is about 1 to 2%. So overall, what we're seeing in these various different components of artificial lift is growth, and I bet gas lift 1.2, so 1 to 2% is what we're seeing in terms of market expectations for the next year. On a global basis, or in North American case of gas lift. So, David, we've kind of talked about the macro. We've talked about some of the broader trends. What are you seeing in terms of customer views and performance, suppliers for artificial lift systems and production chemicals, if possible? Be great to start with rod lift and ESP and gas lift as we just kind of went through.
Sure. Let's go through it and take a look and see what we've got. In terms of the landscape here, we'll start with sucker rides. I think most of the oil and gas operators understand that when we ask the oil and gas operators around the world what suppliers they use for these various services, in many cases it can be quite fragmented. There's over 30 different sucker rod suppliers being cited as being used. When you take a look at the share of spend or market share as a proxy, you'll see that ChampionX has a really large leadership position in North America land, followed by a host of suppliers competing fairly equally across the board, from Tenaris and so forth. When we ask the oil and gas operators to rate the performance of the suppliers with whom they're using on a scale of 1 to 10, with 10 being outstanding performance and 1 being very poor performance, on these critical 7 performance measures: responsiveness to needs, equipment quality, competency of field service personnel, tech support availability, in this case, overall sucker rod performance, and pricing competitiveness. It's very clear, based on the feedback from the oil and gas operators around the world, that in this case, not all sucker rod suppliers are performing at the same level. And regardless if we're looking at rod lift and we start to look at these performance trends, in this case, this is for rod lift for North America land, we find that some suppliers perform better than other suppliers in the eyes of the end user. We see it for sucker rods. We see it for ESPs. We also see it for gas lift. And so this really kind of begs the question to the oil and gas operators. You have many choices of the suppliers to use for lift and for other oil field services, and each of these suppliers have distinctive strengths and weaknesses. It's an opportunity for you to find fit for purpose for your projects. If we come in there and we start to take a look at the competitive landscape, say in North America land for rod lift, since most operators have some element of rod lift in their operations, you'll find that Liberty Lift really kind of stands out for beam pump units, surface units, is delivering best overall value. Lufkin, been in the industry for over 100 years, has a very large installed base and really known for that legacy of rod lift units that have stood the test of time, been in the field 10, 20, 30, 40 years. Weatherford's value proposition being a bit more challenged. When you move to sucker rods, and here in the middle, Champion X is really the performance and share leader. TRC is the leader for used, inspected, remanufactured rods. And used, remanufactured, inspected rods make up about a third of the rod market for sucker rods today, predominantly up in the Mid-Con and in the Permian Basin. And for downhole pumps, Q2 pumps really viewed as delivering some of the better overall value. Champion Hex's performance and competitive position, along with Donan's, has declined year on year. And Lufkin's performance for sucker rods has declined over the last 2 years, but I would expect it to be able to move back over and to the right going into 25 as they address some issues. When you start to look at the ESP market, you see a very dynamic market. In North America land, what you find is that Halliburton has really stepped out and established themselves as a premium supplier, cost more of it, worth it. SLB and Baker both took some steps back, and Champion X is well valued. If we go into our online platform that many oil and gas operators use on their platform with us, and you start to delve into some of these analytics more carefully, say for ESPs in North America land, and we have some independent oil and gas operators that use this platform, and you begin to notice that even though Baker Hughes was sitting over here in North America land in aggregate, the major oil companies and the large independent operators see exceptionally strong value.
They see a differentiation there.
Strong value with Baker Hughes. It's really with the small independents that are challenging Baker Hughes. By contrast, if you take a look at Halliburton, you'll find that Halliburton is viewed exceptionally well amongst the independents, and it's the major oil companies that challenge Halliburton a bit more and tend to prefer Baker Hughes as a top performer. Whereas if you take a look at SLB, the major oil companies see absolute best value in Schlumberger. And so my point goes back to the fact that every oil field service provider has distinctive strengths and weaknesses, right? And to be able to lean in as an oil and gas operator, take a look at your applications, take a look at your geographic proximity to their service centers to see where you can get best overall service and a fit, because not all oil field service providers are meant to serve every operator and vice versa. Okay.
Well, and what's interesting about this market in particular is the range of service supplies you actually have at your fingertips versus, say, let's say rotary steerables in North America, which is a 3 to 4 horse race depending on who you talk to. This, you've got a swath of suppliers depending on what you need as an operator.
Yeah. And even when you go in and do a head-to-head, say Baker Hughes versus a Halliburton, you'll start to see how, in many cases, they're performing very similarly. If you put this in the Permian Basin, and you do a Baker Hughes, say, versus a Champion X, you can see where Baker Hughes has some strengths around pump quality and so forth. And so everyone's got strengths and weaknesses, and it's incumbent to kind of drill down. For example, in the Permian Basin, obviously, Halliburton's strong in the Permian and the Mid-Con, but when you move into the Bakken, you see Baker Hughes and SLB begin to flex their muscle, right? And so as you kind of move around, you'll see these variances. Internationally, it's more of a SLB Baker Hughes race for leadership. The same thing internationally in this large ESP market. There's some others that are out there. Halliburton's trying to cut their teeth and enter the international land market. Their value proposition is being challenged just a little bit. In the gas lift market, you see Liberty Lift improving year on year, viewed as delivering strong value. Flowco and Priority, very strongly valued. And Champion X has moved from discount to premium along with endurance. When you move into, say, the plunger lift market for U.S. land, you'll find a very tight race between Champion X, Flowco, and Epic. And, Epic and Priority are part of the Tally Energy Services family from a branding perspective. PCPs principally up in Canada and in select areas. It's a strong area for Weatherford, for example, and lifting solutions, as you can see, for rod strings and downhole pumps. Weatherford's strong across the board here. And you see internationally, Weatherford exhibits some strengths with the rod strings. One of the things that we notice in this market, maybe transitioning to production chemicals for a second, is they too have a big variance. And we find that J-Chem Catalyst, part of the CS family, is viewed as delivering really strong value for chemicals. And if you start to break this out, you've got suppliers like Aegis, you've got CES or J-Chem Catalyst in US Land, and Coastal and Chemtech and Credence, all being acknowledged through the operators as delivering strong value. We definitely see variances by basin, be it the Permian or the Mid-Con. And when we get into the Canadian market over here, well, don't have one in the Canadian market, but Pure Chem addresses really well. When you move to the broader international market, you'll find that Baker Hughes and Champion X are really viewed as competing very similarly, but Schlumberger, albeit much smaller, obviously, they're delivering very strong value, positioned to grow. Halliburton, this is a huge growth area for Halliburton as it is for ESPs. But just like we saw for ESPs, for Halliburton's production chemicals, their value proposition still being a bit challenged, as well as offshore. Champion X is well positioned as we get into the offshore market.
And David, based upon, we talked about production solutions, we talked about NTBF, are you seeing a greater linkage between chemicals and artificial lift and the ability to solve challenges, both the mechanical with the chemical, potentially with digital as well? Are you seeing some of that stuff?
Sure. When we ask the oil and gas operators what's failing on your artificial lift system and what do you attribute to be the root cause, you're right. The oil and gas operators very commonly attribute the efficacy or the lack of effectiveness, really, of their production chemical program as contributing to the failures of their lift systems. They commonly will cite scale, corrosion, wax paraffin. Naturally, they're all spending money to address these things. It's just that the effectiveness levels of these chemical treatments are not sufficient in order to prevent the failures that they're finding. In fact, in our production chemical report, really only about 1 in 4 to maybe 1 in 3 operators believe that their chemical treatment programs are working really phenomenally well, with a rating of a 9 or a 10. If you take the ratings of 7s or lowers, you literally have more oil and gas operators either questioning the efficacy of their program or saying it's not working than those that know with certainty that it's working.
Opportunity for improvement.
Yeah.
And is there anybody who's best kind of positioned to address some of this?
Yes, there is. I mean, if I'm an oil and gas operator, I would want to take a look at a holistic production solution. Okay. I know that I've got chemical failures, I've got mechanical failures, and I need some digital help from chemical injection pumps to monitoring downhole pressure and temperature and gas optimization rates on my gas lift systems. And you really need an operator, oil field service provider that can connect the dots. And there's several that are out there, but Champion X is one that stands out because they're clearly technology agnostic across the swath of the artificial lift platform. And they have a very sizable production chemical chemistry knowledge. Naturally, Halliburton and Baker Hughes and Schlumberger all have similar expertise in North America, US land, as it relates to ESPs in chemical, right? But they don't really offer gas lift, plunger lift, and rod lift. So, and I'll just wrap it up with this observation. We commonly talk about the market's all price driven. In reality, there are oil and gas operators that are really looking for differentiating technology and performance or differentiated service quality. And yes, there are some operators that really are looking for low price. And what we find, like for ESPs, Halliburton is best viewed as delivering the best value amongst the oil and gas operators that recognize the value of good, consistent service quality and differentiated ESP performance. Oftentimes, the price buyers will tend to gravitate towards some of the more regional players, like Al Kharif, for example, internationally, is really kind of a favorite amongst operators for those that are really price sensitive. But amongst the international ESP users that really value differentiated performance, then they're going to go to the heavyweights of Baker Hughes and SLB, right? So being able to identify fit for purpose for what you're looking for is really, really kind of critical in this market. And no matter where we go for any product line, we're going to see some segmentation of operators looking for just price versus differentiating performance. I guess to maybe wrap up, Andrew, maybe share some thoughts about how you see the rest of 24 playing out, but maybe your insights as to what we should be expecting for 25.
Okay. Interesting, challenging question on October 1st. But, right now, the balance of 24, I would say flattish, and I know that doesn't sound exciting to a lot of people. That's kind of where we're at. We're going to have some seasonality towards the back half of the year. We've got a lot of factors in play right now as we enter budgetary season. That's going to drive a lot of things. We've had a lot of conversations with OPEC. We have an election in the US, which ultimately will also have a policy impact both this year and next.
Right.
But when I take a step back, these efficiencies and that productivity growth we saw at the very beginning of our presentation, is it continuing to grow at an accelerated rate? Probably not, but it's still growing, or at least decelerating. So that's going to continue to allow US land operators to accomplish more with less. Those OFS suppliers who are able to kind of offer that technology and service to drive those efficiencies and productivity, I think they're going to be very well.
Those are the winners.
They're going to be the winners. They're going to be ones best positioned in the marketplace. As you said, we often get challenged at entire markets commoditized. Well, our data doesn't actually suggest that. It suggests that those who can offer differentiation can drive differentiated performance.
I share an example with you because that brings up a conversation I had with an operator.
Mm-hmm.
Many oil and gas operators have been adopting these oriented perforating guns or these self-oriented perforating guns, and they very commonly may cost $30, $40 more per perforating gun than a conventional, traditional integrated gun. You may end up spending $20,000, $30,000, $40,000 more using these new perforating guns. But when you use these new perforating guns, even though it costs you more in perforating guns, you frack the well easier and more quickly. You save time on frack.
Yep.
Save time on water, chemicals, and you get better productivity out of the well bore. And it's these technologies that are contributing to allow the oil and gas operators to produce more oil and gas out of every well that they drill, which is why our production levels remain resiliently high, even though we're going to drill 15% fewer wells. Never in the history of the United States oil and gas industry have we declined our drilling activities by 15% and dropped the rig count the way that we've dropped the rig count and increase production. No. Never been done before.
It's remarkable, quite frankly. And so I think that's going to continue to be a huge lever. OPEC's a lever. Demand is a lever. But broadly, it's going to be a flat to tight market. But one thing either direction can swing this. And, we're talking right now, and there's things happening out in the news that could swing the price of oil and commodity prices either direction. So keep buckled in. It's going to be an interesting ride.
Stay strapped in.
As for us here at Kimberlite, we've got a lot of things going on as well.
What do we have going on?
Next week, October 8th, we'll be hosting our 46th webinar on perforating and completion fluids. So we can talk a little bit more around oriented perforating guns.
All right.
Following that, we'll be publishing our formation evaluation studies in October, which is going to include wireline logging while drilling, mud logging. And then in November, we're going to have liner hangers, cementing tools, cementing services, surface wellheads, and subsea wellheads all coming out, so we get an understanding from the drilling side of things. And then at the end of the year, going into January, we'll be wrapping all things up and looking at performance of the big four oil field service companies into the new year. So a lot coming up over the fourth quarter of the year.
So in January, look to us. We'll have the update for the Permian Basin report and the Middle East report, assessing the big four guys. And really appreciate everyone listening in on the webinar. And feel free to reach out to Kimberlite if we can assist you in any way. And we appreciate all the support that we receive from the oil and gas operators around the world as we produce these industry reports. So from now, we'll sign off and we'll see you next time. Thank you. Bye-bye.